So Chris Marcus had noted the open interest, how big it got. He wrote a couple stories on that, and then he and I had some conversations, and basically the question is, are they nervous or not? And the commitment of traders report tells me they're nervous, and it's not obvious. But if you understand options, it'll be obvious. We're not going to get deep into the options, but I'll just show you what to look for. That's the second thing. We're going to spend a decent amount of time on Bollinger Bands because it was such a nice trade for silver, and one went off in oil. Scott pointed that out to me when he asked me about it, and I'm like, "Oh yeah, we did have one, and I missed it." Right, Scott? What day was that?
It was a nice trade. I think it was the 8th of June.
Fucking A, man. Excuse my French, everyone. All right, so we're going to touch on the oil trade, and I'm using these as examples. Like you can be in a classroom where you're talking about the textbook, right? And sometimes we do that. But when events happen, you need to be able to take that opportunity to put more tools in your toolkit. So I'm looking at you guys as having toolkits, and if I have an opportunity to refine a tool or give you a good example of how a tool works, then we'll do it. And we've had two of those in the Bollinger Bands, and I see a couple questions about them as well. So I can talk about it ad nauseum. Randy understands it as well. And I actually have something new to add to the Bollinger Bands for butterfly and condor traders. So Randy, I think, and I would like that. But it would also be helpful to people that are hoping for a breakout. Is it a breakout? Is it a breakout? It gives you a little bit more filter. Next, oil. I didn't go through the commitment of traders on oil, but I started to look at it. It's very complex. And put it this way, I'm too lazy to go through it like I used to, but now it's WTI, it's Brent, because Brent's a more important contract than WTI now. It used to be that way forever. As oil demand moves east, the center of the oil world moved east. For years it was Brent, and then in the 90s it was WTI, and then it started to move back east as Brent went over TI again, and now the whole thing is like, when they run out of oil in the North Sea, it'll probably be like Nigerian sweet or something like that everyone looks at. But WTI, Brent, WTI ice traded. There's a lot of contracts to combine now, and I'm just too lazy to do it. But I know what's going on behaviorally from the general aspect of it. Basically, it's what's going on in gold. What else? I'm also going to give you a back of the napkin way that I look at how much upside we have in gold. Okay, again, it's back of the napkin, but it serves well when you're trying to get a handle, when you're in an area as gold is about to be on the area of uncharted territory again. If we keep going higher, it's like, what's your next target? People will say Fibonacci's, or they'll say, I used to say Gann lines, or they'll have that measured move concept that I talk about. But there's a very easy way to get a good idea using open interest, especially if you're looking at commitment of traders. So I'm going to do that as well. All right. I hope to do this in, it's 2:09. I hope to be done by 3:10 for Father's Day, for your time as well as for mine. So let's trade some options on that. Let's assume that the option that I'm going to say 3:15. We'll be done at 3:15, or I'll be done at 3:15. Who thinks we're going to go longer than 3:15? Right?
Me.
Of course you do. Of course you do.
I'll take the
Right.
under.
You'll take the under? See,
Under.
there's
I'll
Under.
take
The
the
the fix is in. The fix is in.
because I'm
well,
going to
the fix
ask
is
you.
only in depending on who pays me the most money, right?
Well,
That's how it works.
I'm going to ask you who you've got something cooking with MSA. Any chance you're going to do that with Polytrends? You're going to let us loose on that?
Oh yeah. See these questions? He's going to take the over. See what he's doing?
Yeah.
Right?
I mean,
No,
I've been
I'm
waiting
not
for
going to do
weeks
it
to
today,
ask
but
that.
starting going forward, today's not a good day to do it because I am on a little bit of time constraint. But going forward, I want to start gambling. All right, not for money, like maybe for pennies or nickels or dimes to keep us honest, but we'll start trading options on how long this goes. This way we can all get a feel for options that don't understand them without causing pain. Basically, options are an over-under tool. Football, football game, over-under spread. It's going to be over.
Bets have to be placed before the webinar starts, before 2 p.m. How's that?
Yeah, something like that. Exactly.
Yeah.
Exactly. We're not going to do it today, but I just wanted to mention that, it'll keep me tight, especially if I start. I can't bet, but I can make markets. All right. I'll be a market maker. That's the point. I'll be the market maker. You guys will be betting, and I'll guarantee every bet. We'll do it for pennies or something like that. But we'll keep a running total. Okay, so let's start with the. So we've got the Bollinger Band. So hold on, let me get because my notes are really very cryptic today. Oil, Bollinger Bands. Gold weekly breadth. I want to do that too, right? That's good. Weekly breathing, I should say. All right, so why don't I just go through it? We'll just go through this as it comes up. Let me get the right page up here. All right, we'll start with the commitment of traders. Clean work, right? So we'll just start with that. Let's make a little bit more. We don't need to see this, right? So we'll go here. A little bit more room. All right. So here's the week. 5 days in red. Last 3 days not covered by the report in purple. 5 days in red was a down week, right? It's not a trend day lower. It's not a trend week lower. It's a normal variation. So it's a serious down week, but it's not a collapse in terms of terminology, right? So yeah, Monday was an up day. Tuesday started strong. Looks like some people got stopped out or stopped in, and then they got slammed, right? Next day is a classic down day. Next day, an up day after making a low. There's your fish hook, right? And then this day, open interest goes up and the market is nowhere. And then, boom, that happened. All right, so just to walk through, when you're looking at these, you're trying to figure out what's going on, right? This is Randy Blavish chart here on the right. Then I kind of make a hybrid there. And we go like this. We'll do the big boys are back in a second. All right, so on day one, the market was up within the range. 1,300 contracts go in. I'm looking at this right. 2, 3, 4, 5. Yeah. So one more thing. The week on net was boring, open interest wise. It was a confirmation of the COMEX dying. It also really was a confirmation of the market having very little interest. But no, those are not small ranges. Those are big ranges with no volume. That's how silver trades. The market is trading like it's broken. I'm not saying it's broken. I'm saying it's trading like it's broken or hung over, or there's no big players watching it right now for all the reasons I talked about before. But let's see what goes on. So, and then on these 3 days, it snaps back to the way it's supposed to behave when things are going on. So here we go. This week, behaviorally is normal. By normal, I mean the funds were in control. They drove direction higher. They drove direction lower. So on day one, we'll go back to this. Let me get my a drawing tool here. Is this it? No, that's not. They always do that one. Right. Okay. So day one, the green day, 1,300 contracts. The market is up a little. Day two, the market opens, goes higher, and then goes lower. Look at this. It makes a new high, still below that high, and someone smacks it. Who smacks it? I don't know. Open interest goes up by 800 lots. So on this day, you don't know if it's new short. It's new shorts and new longs getting in. But in the first half of the day, buyers initiated. In the second half of the day, sellers initiated. I don't know if the buying was short covering, right? The buying could have been short covering, and then the market comes off. More likely the buying was fresh buying because there's a little bit of a bull flag here. And someone said, oh, look at that. It broke above this. Let's buy it. New highs, some buying comes in, some short cover comes in, big selling comes in. And so basically you have people buying the dip all the way down, but they're locked, they're getting in and they're not making money. So new longs did not make money on this day. New shorts, however, did. Next day, market has a big down day, down 2,100 contracts. So you can make the case that The market's down significantly on light volume. I'd have to look at the volume, but the open interest doesn't change much. If the volume was heavy, that means if the volume was heavy, then that means there were people buying the dip. If the volume was light, then that's just people puking. So we'd have to look at that. I'm not looking at that now. The next day, open interest down another 1,400 contracts with the market up. So that would be the market going up, right? The market starts out, goes lower. See what happened here with people buying the highs? People sold the lows here. Market opened here, made a new low inside this congestion area, right? And they got stopped out. So I think you had new shorts selling the open and new longs buying the close, just like you had new longs buying the open and new shorts selling the close here. So these are kind of like a bookend trade. Then you have this day, which is the mystery day, but it's the day that makes you think it could be a fish hook, right? So not a pure fish hook, but we don't see pure ones anymore, but we do see them. Market is unchanged, peaks higher, peaks lower, but open interest is up 2,600 contracts. This would be your Paul Tudor Jones types buying this area. It's off the lows, it stays in here. Somebody starts covering, somebody starts buying, but they have an opportunity, a window of opportunity to buy. Then we go to the last 3 days, up 6,000, up 9,000, up 9,000. So Randy and I, and we've all noticed this, but Randy and I have noticed that rarely do we have 10,000 days, 10,000 open interest days, 10,000 contracts of open interest coming into the market on days before macro discretionary got involved. And when they do happen, like for example, in the old gold, you would have a 10,000 contract open interest here, and that will be the end of it. And then the market would crap out. Now in the new gold, you have, these are 9,000, but I'm calling them 10,000. You have 10,000 lots of open interest getting in on 2 days in a row. That's macro discretionary getting in. And it's not the end like it used to be. It's closer to the beginning, especially when the open interest is on the lows. So I'm saying the big boys are back, and I'm saying that the confirmation is given by the volumes and the open interest changes. The behavior is given by the geopolitical reasons and what have you. So I have said in the past, in a not too distant past, that I'm worried that macro discretionary won't come back because of the fixes in on the market and the market is capped. I still believe that. So we may not get as much buying, but we are going to get people buying. So that's something to think about. It's good. There's like, I'm not throwing water on it yet. I'm just saying it's good. It's like, I'm going to be very bullish by the time this conversation's over. All right, so there's the big boys are back. Let me see.
Vince, can I throw in something?
Yeah, hold on 1 second, Iggy. Oh, look at that. Wait, is this the Iggy that didn't used to have anything to say? Used to type everything?
We type everything. We lost power at our house today for 2.5 hours, and so I had to join by phone.
That's funny. That's funny. Hold on to your question. I want to answer Arenas first. Didn't we have large volume days last time the conflict broke out? Yeah, we did, Arena. I don't remember exactly. Does anybody remember exactly what was going on then? I mean, I remember what happened October 7th. The Gaza invasion started, and we had noticed, and I dismissed it, but we had noticed couple large volume days on the lows, and it seems like that's when I started talking about the concept of bank traders get tapped on the shoulder and say you should cover, something's going on. But did we have large volume days back then as well? We had to have, right? We had to have. Can anyone contradict that? Unless you're being rhetorical. Are you being rhetorical, Arena? I'm going to say yes, we have large volume days.
No, I'm being dead serious because I think we talked about it.
That was the October 7th, right? That whole thing?
Yep.
That really stuck out. That period really stuck out because a couple days into the war, we got the open interest. And I remember looking back going, look at that. We had shorts covering on the lows. It's like, damn, those banks are smart. And we talked about the tapping on the shoulder thing. So I think Arena's comment here only makes us more bullish, you know? Okay. Let me, I have a lot of like little things on my screen cluttering it up here. All right. So Iggy, what's your question?
It was a comment regarding the last 3 days of the week. Obviously, the Israeli hit on Iran was on Friday morning at 3 a.m. and that volume started up several days before, even before
Oh,
they
yeah.
started removing their, diplomatic corps from places in the Middle East. But
Yeah.
I wanted to throw out that I saw a graph of the put call ratio, which has
Oh,
been
yeah.
dropping, and the calls, which about 30 days ago, they started paying up, and they like so,
All right, Iggy, hold on one second. You're hold on. Your signal. Do you hear me, Iggy?
I can hear you.
Okay, your signal's chopping up. That cellular in and out thing. But I'm going to try and make sure that I get most of it out to everyone. On what he's saying is, tell me if I'm getting it correctly. Is that before the invasion, the market rallied, and during and before the first part of the market rally, the put call ratio changed. Is that what you're saying? At least part of it?
Yes, and that was dropping.
Yeah.
Longs increasing at the bottom.
Okay. Jesus, I'm going to ask you to go back to typing. It's hard for me to hear you. I'm thank you for contributing. So everyone, what he's adding is that smart money was getting in before the bombs dropped. Smart money was getting in even before, if I'm hearing you right, Iggy, smart money was getting in even before the Trump warning went out. Is that right? Is that what you were saying?
That seems to be the case.
Yeah, okay. Yeah. So there you have it. I mean, uh yeah, I mean, it's classic. Classic stuff. Now, mind you, these things happen probably a lot, but this one was a little different. And all right, so there we go. We know it's for real. I personally, just throw a little opinion out there. I have been reading opinions about this. You saw the J.P. Morgan and Goldman ones. J.P. Morgan, it's worse than it looks. Goldman, it's not worse than it looks. I saw one from BCA, and as much as I like them on certain areas, I heard a take that I didn't really think I didn't agree with it. Let's put it that way. And their comment was, I didn't send it to you. Their comment was, we don't think it will last long. I'm simplifying. I'm not mocking them. We don't think it'll last long because they haven't lasted long in the past, citing the one last year when in 2023 when Iraq, these short-lived things. Basically Israel attacked and Iran did a pushback just to show that they're tough, and then it ended. It was over. I remember that one, and BCA was saying we think it's going to be another one of those. And in my mind, it was like there's no way it's going to be another one of those. I read this like the day that it started. I'm like, there's no way it's going to be another one of those because and this is like where subjective probabilities come in. Trump closes the deal with the Saudis, locking in the Saudis. Trump closes the deal with the Middle East. I mean, with China, and then Netanyahu just decides to start bombing people. I mean, and Trump is talking about we want to have a negotiation with them. He's always trying to take credit for stuff, and that's great because he's giving warnings to people doing that. So anyway, there are people out there that don't think, not everyone thinks like, I think this is going to be a problem, right? I think this is going to be bigger and more chronic. There are still a lot of people out there, call them neo-Keynesian or the past is prologue types, who think this is not going to be a problem. Now, maybe I'm wrong, and maybe this will end. But I think it ends with everyone coming together, or at least not attacking each other, and everyone gangs up on Iran. I really think that. But that opinion is really not valid, except that it's an opinion. The reason I brought that up is because is I think this could go on a lot longer than it already has. Number one, right? Uh, Number two, to Arena's point, we saw a lot of volumes and we saw behavior like this in October, October 7th, right before October 7th, and right after October 7th. And number three, to Iggy's point, we saw buying before, like the third day, that's Friday, right? Friday? Yeah, Friday. Friday. Look at this. This day is Friday after the bombs drop. This day is Thursday after. I see that, Iggy. I'll get right to you in a second. The Thursday was after the warnings went out. Wednesday is before, and the calls are being bought too. Get Iggy, say it. You trying to talk? Or you typing? Oh,
I
before
sent my comment in the chat for you.
I say it. Before medicine and public health, my background was in the Middle East. Thank you. There you go. So there you go. He's got some Middle East experience. Thank you. That's very timely, right? I knew we kept you around for something. Thank you very much. Yeah. So I haven't gotten, that's good that you're saying that because I haven't gotten feedback from my guy who's actually he actually writes for us now. Okay. When you see those geopolitical things, that's Mavs. And Mavs is in Asia. I'm not going to say where, but he's actually worried. And he also knows retired military people, and he is military affiliated, and he knows a lot of, not a lot, he knows some Israeli retired Air Force generals, has a couple friends of that. And he's got a very military intel type of mindset. So I haven't talked to him. So Iggy, thank you. Other than what I just said here, Iggy, what gives you the impression that this isn't a short operation? Other than the obvious, what do you see that we don't?
Well, again, I lived in Israel for 2 years and
Right.
was very involved in kind of Israeli and American politics. And my background was in the Arab-Israeli conflict in the Middle East. But to that being said, I monitor what's coming out of Israel and the kind of the behind the scenes thing.
Right.
And unfortunately, as a historian, which is my first training, we won't ever really know what's really going on until months to years later.
Right.
But from what I'm hearing from the inside people, that this is definitely at least a few week operation, and it may be a little bit more. But I have a feeling they want to keep it limited to various components of what will impact their ability to make a weapon. And they probably have some other, obviously other targets too in the IRGC and in, with the Ayatollahs and whatnot. But, my guess is that the Americans have had them limited in scope, and this is a guess, and that they're not going to attack major energy sources, but them attacking, say, natural gas would benefit the Americans, for example.
Right. So I'm going to paraphrase you from a different perspective. Most important part of Iran's infrastructure, or at least that I know just from my energy background, is within the strait, there's an island called Kag or Karg. I forget I don't even know how to say it. It's KH, right? And I put that in the post. And they have a lot of their refinery capacity there. And Israel wants to attack things that will, publicly, what they're saying. Israel wants to attack things that will cripple their ability to make war. Nuclear would be first, and that's why they would want bunker buster bombs and things like that. But the surefire way to really cripple them is refinery capacity, and refinery capacity because they can't. You need energy. I don't mean just oil. I mean refinery capacity. So you cripple that island, that whole area, and you take down 80 to 90% of their oil. That's where their shipping comes out of as well. It's not just their capacity, but their refinery capacity and their shipping are there. And that'll be the one place that if Israel attacks it intentionally, then it's on. And what I mean by on is to kind of echo what Iggy's saying. If they attack that, they're really going against what our wishes are. You follow? If they attack everything but that, then we know they're on the same mindset that we are. That's pretty.
It makes sense because if your goal is regime change, you want to prop up the new regime, which is ostensibly friendlier than the Ayatollahs. You want to be able to get them up and running with money, prop that government up as quickly as possible, and that means leaving all the income producing assets like oil and refineries
Right,
intact.
right. That's true. The bonus for the whole operation is, uh, I'm getting conflicting information on this, but I know that most of Iran's oil goes to China, and so we're kind of, I wouldn't say we're crippling China, but it's kind of a pain in the ass for China. They have to get more oil somewhere else. They have to pay higher prices, and I made a big thing about it on Twitter, but I'm really not as confident as I was the first time I said it. But I do know that it's not good for China. I also know that uh, I think we're going to bring it. Anyway, my opinions aside, let's go right into this. Yeah. So I appreciate it all. So our conclusion, I think, from this little conversation is is this is not going to be a 2 days and done type of thing, and it's already not a 2 days and done type of thing. All right. So down week, normal variation week, textbook days, textbook 5 days. I just went through that. Another almost perfect fish hook, but it's going to follow through max. All right. So I said that. All right. So here we go. I can make quick work of this. Remember, so I don't know if the volume was light on these 5 days, but the open interest changes were light. We just had a big options expiration. So there's a lot less reason to trade unless you're initiating. So kind of look at it this way. Everyone's balance, I'm saying this from a constructive point of view. Everyone's balance sheet is clean. So anyone who gets in now is getting in for a reason. They're getting in because they have a real reason. And gold is no longer sleepy, meaning, you used to have to wait for a new quarter or a new half-year high. Now it's like, oh, a new high on the week in gold, let's buy some. It's become on the top of the menu all the time. It's become that short video that keeps popping up in YouTube that you scroll through. Okay, so here we go. On this week, most of the changes are very small. So the market, on those 5 days, the market started here and went down. So started on the highs, closed almost on the lows. So what did we see there? The longs, the other reportable longs, were the biggest sellers, right? And I'm pairing up. They don't have to pair up this way, but I'm pairing them up. These guys sold, right? So that's longs getting out, okay? Swap dealers sold, long swap dealers. I think that's significant. It's becoming more and more significant. I'll show you. I'll show you why in a second. Merchants or end users sold. All right. Short managed money added. Right. Now, who bought? Short swap dealers bought, but not a lot. Okay. Managed money bought. That's a surprise. Managed money bought on the way down. I mean, it almost seems wrong. But anyway, so here it is. But the big players on the week are on the long side, other reportables, you could say puked, right? And long swap dealers, you could say puked, right? And I don't really put a lot of, these guys are specking a little bit, but these guys sold on the way down, and these guys sold on the way down. That's odd. Usually, if this is negative, that's negative. If this is positive, that's positive, because the longs are getting out and the shorts are getting out. So they don't necessarily trade with each other, but they almost always seem behaviorally to do the same thing. They put on open interest, take off open interest, that type of thing. So there's not a lot of importance in here, but the important thing that I'm seeing a pattern now is this. In metals, the long swap dealers, which I've upticked in their importance over the last 6 months, are now trading similarly to the other reportables. Okay. So whatever these guys are doing, these guys are doing. I don't know who's leading and who's following, but I would guess these guys are leading and these guys are following. So let's move to the options. The options are here. The options, again, we just had a big options open interest expire, and there isn't a lot of fresh information here, but there is a little bit of information that I think is worth looking at. And that is, all right, so here we go. So the ones that matter I have circled, right? So other reportables, the guys who puked, they bought calls in the dip. So they sold futures, 1,700 contracts, but they bought calls adding up to 500 contracts. So these guys were buying the dip and options for them. I don't think they were short calls.
List
I know
of
they weren't short
spots.
calls.
Find the one that you want.
All right, so next, who else bought calls? Watch, guys. The long swap dealers sold futures, but bought calls. So these guys bought calls, and these guys bought calls. I think these are the bigger players. They're not always right, but these are the bigger players. And I think the swap dealers have them as customers. Okay? I'm not married to this, but it's not that hard to figure out. If the short swap dealers have played short their whole careers because they have the producers for clients, then the long swap dealers have the natural buyers. Could it be these guys? Yeah. But not here. It's usually these guys. So I'll give them names. This is Chinese macro discretionary puking, but they bought calls. This is Goldman Sachs long swap desk puking, but they bought calls. You see that? Doesn't have to be that way, but I'm noticing that the behavior of the swap dealers and the other reportables on the long side are really starting to lock up. I've seen it for about 3 weeks, but this week it just jumped out at me. So there you go. So the reason I bring this up is because contextually, they may not be right every week. Like they're not right this week, right? They sold it into weakness, but they've been far more correct. These two guys have been far more correct than these guys. And even these guys. So it looks like this week these guys ended up being smart because they bought the dip. And these guys sold the dip, but they bought options. The point is, I think the smart money resides with this partnership. Need a couple more days to make sure that I'm right on that. All right. Why do I not see chats? All right. So, yes, Nick, let me do that right now. MSA. Let me pause the recording. Wait, I paused the share. I want to pause the recording. How do I do that?
So just to follow up on some of what you're saying, it's been my sense, even before Trump took power, that the various regional players, and understand this is the Saudis, the Emiratis, the Turks, right? That there is probably some type of new agreement, and that they are literally, creating a new Middle East out of everything that happened. So that's what I've been seeing, watching from like kind of the big picture as opposed to
Right.
all the news events.
Right.
It looked to me like they've made deals with countries like Turkey and with other countries to make sure that they.
Wait, no. Wait, I want to ask one question because I'm trying to follow this very close. I'm looking at the map in my head. Who is they? They cut deals with. Who is they? The U.S.?
So
Real?
again, yeah. So I would say the U.S. and the Western powers for the most part. But again, I don't want to get too much into Europe because I don't know European politics as well.
Right.
And this is where
Right.
understand so much of this is deception. This is why
Right.
anybody who kind of watches the news and thinks they have things figured out, I can tell you as a historian of this area,
Right.
we're almost always wrong, right? And for decades. I mean, my background goes back in the early 90s to this.
Right.
So my hunch is that the United States, along with let's say Canada, the UK, France,
Right.
probably Europe, has made a deal because even if you want to go back 500 years on this, right, the goal was always to stop the spread, of Islam from
Right.
slaughtering all the minorities and all the Christians and everything else, right?
Right. Those are noble reasons for that. Yes, exactly.
Yeah. So,
Yeah.
so, and even when I was in, Washington 30 years ago, talking to some of the, ambassadors and diplomats, I was asking at the time, having read, maybe this is 28 years ago, Brzezinski's Grand Chessboard had just come out, and I studied it, really
Great book.
closely as a historian.
Yeah.
And he was talking about how the Caspian Sea then was the number, basically the number 2 in petroleum reserves in the world and the number 1 natural gas reserves. So don't
Right.
forget that Iran, on its northern border up by Azerbaijan and the
Mhm.
Caucasus, right, is fully tapped into that, and you have Russia on the other side. So
Right.
the Caspian and the control of that, kind of the Caucasus. The Caucasus, even going back to World War II and before, it's always been like the key for controlling kind of the world. You
Right.
control the Caucasus, you control all of Eurasia, and then you control, the largest population centers in the world. Anyway, so
Right.
I have a feeling that the U.S. and Turkey and Saudi and the UAE and Qatar, and I have a feeling Qatar gets paid to be the bad guy, right?
Right.
And pretend that it's on Iran's side, and then they get this reputation as a double dealer. When I have a
Right.
feeling they're an asset, just like
Right. No.
Israel is an asset. Israel's too small to be, what we call a macher, a
Yeah.
maker, like a kingmaker. They're always controlled by bigger powers. Anyway, that was the general comment I wanted to offer.
No,
Yeah,
and that's good. Let me add to that just before I let everyone else chime in. Um, um, the way it was put to me, not what you said. I can't claim to know what you said, but the way it was put to me is that the whole CIA or whether it be it's kind of like this. The example was given to me was Erdogan, right? Erdogan is, by all counts, by people that I speak with in Turkey as well as here, is that Erdogan is a horrible domestic governor, but internationally he's the best. Now that's their opinion. So Iggy, I know that you have expertise in this area. I'm just telling you their opinion. He said, "How would you approach Erdogan if you wanted him to be involved in something?" And the guy was telling me Turkey and Syria are part of the future because they are the plumbing. They are where the pipelines will go if they do go, from the Middle East to Europe and all, the whole land traffic. And that's why what are they called? ISIS was so powerful for so long, the plumbing and all that. He said, "How would you approach?" See, this is, I think, what a lot of people miss when they say, "Oh, is there a plan to change the world?" And I know there is, but it's kind of like they don't get together and have a meeting and say, "Okay, this is what we're going to do." Maybe they do, I don't know, because the guy described it to me like this. He goes, "What we do is we go over and we tap Erdogan and we say, 'How you doing? How you doing? Hey, listen, hypothetically speaking, if this were to happen, would you have a problem with that?' Well, what's in it for me? Well, if this were to happen, you'd have to be involved because then oh yeah, I'd be interested in that." So it's almost like you get everyone to say, "We'll watch, we won't publicly say anything. And if it goes our way, we're going to line up at the table." There's like it's like hypothetically speaking, if this were to happen, would you be okay with that? Oh yeah, sure, I'd be okay with it. And then so that's how you get guys like Erdogan on board. And Syria, I guess they couldn't get Syria on board. So they're like, all right, I guess we're just gonna have to tear that shit up.
Well,
So
Vince, let
yeah,
me add to that really quickly. So this is where people, I think, and we get these different flavors in the United States and the English speaking countries, and again, so much of what's happening in the media and on the left woke and the right woke. These are
yeah,
parts of from what I read from it because of how disconnected they are to the reality on the ground.
mhm,
I almost suspect that they are basically counterintelligence and or disinformation operations for international consumption. And then really smart people grab onto it, and because of their own ideological biases,
right,
either are for Ukraine or for Russia or for
right,
Israel or for everybody else. But Iran was really trying to create the competition really in the Middle East. The issue is the Sunnis versus the Shia, and
yep,
in Iran, it's mostly Shia. In Lebanon, there's some Shia, but they were controlling, all these other countries, Lebanon, Syria. They were making inroads in Jordan, in Iraq, down in
right,
Yemen, right? So you've got all these countries and Sudan. So Iran was trying to take over the Middle East, and what they really wanted to do was take over Jerusalem, so then they could say, "Hey, Saudis, you guys may have Mecca, but we have Jerusalem. We are the
right.
center of the Islamic
Dome of the Rock
Caliphate."
stuff.
And then
Yeah,
you've
yeah,
got Erdogan wants to kind of do something similar, but in the Middle East, you have to pick your poison, just like any like the Caucasus, you
right.
have to pick your poison, and so sometimes it makes for
Right.
bedfellows and dirty alliances, but that's how power has worked. Machiavellian power has worked for thousands of years. So understand that Syria, they had a minority, the Alawites, that controlled Syria, and that was run by Iran. But all of
Right.
Syria and Lebanon and Jordan and the Palestinians are what created the Ayatollahs, and they also helped create and train Hezbollah, and they helped create and destabilize Syria. So when all those dominoes started to fall, Iran's influence in the Middle East fell, and the Emiratis and Saudis and Turks could rise again. So
Right.
that's the transition that I'm seeing, if that
Right.
helps.
Right.
Hey, Iggy, I've got a question for you. Um, you'd mentioned whoever controls the Caucasus controls the world. That's a really rough neighborhood, and I wonder what you mean by control, because from my perspective, maybe you mean like controls the oil fields in the Caspian, because I don't see a lot of land occupation in the Caucasus going well.
Yeah, well, it's like Iran, right? It's a highly mountainous region that is very difficult to take control of. This is why, say, the Druze in Syria, Lebanon, and Israel, they live up in the mountains, because if not, they would have been slaughtered by many of the Shia or the Sunni Muslims. And you see the Kurds up in other areas too. They live in the
Right.
mountainous regions. The Kurds in Iraq and Iran and Turkey and Syria. And so I think I'd read Britt's comment that, you see the pipelines and you see everything that you need to know what's going on. I think that's probably fairly correct, right? But it's bigger than that too, because it's not just on the kind of the left, the left, I'll call it the left critical perspective, that it's like the corporations are doing this, therefore we're doing it. This is how global power, right? And the various global powers that are in competition with each other are competing. But those caucuses, that's why Hitler was hoping to get around those. If I remember correctly, again, I could be
No,
misremembering my
you're right.
history.
You're right. That was the original drive to
He wanted
Stalingrad.
to get around there, and then he was just going to, come straight through the Middle East, because the rest of it's so flat, so the army can just.
Let me add something to this, James. I think I can add some. I want to add some color to what Iggy's saying, James. I mean, I think if I'm wrong, tell me, or if I'm remotely right, tell me. The Caucasus is an intersection. It's everything. It goes from Europe to Asia. It goes from Asia to the Middle East, and there are a lot of natural resources there. So it's an intersection, and because it's so mountainous and because it's so rough, aside from the natural resources, it's hard to control. And it's also for all these reasons, it's also a very natural land barrier. So the reason I know anything about this is because I would study Italy, and Italy has these vertical mountains. And during World War II, that was a big deal, left of the mountains and right of the mountains. So it becomes an intersection. And maybe you can't literally control the intersection, but you need access to the intersection for your plumbing. You need access to the intersection to get the natural resources out. So if you control the intersection, then you connect Europe to Asia. So if you're a natural resource producer, like most of the BRICS and the Middle East and Asia are, and most of the GDP in the world is in the West, at least as it was for years, you needed to get your product there. And so the Caucasus or the desert, if you're going through Turkey, right, or even Afghanistan and Syria, the Caucasus are, three things. It's a natural boundary because of the mountains. It's relatively rich in natural resources, and it's contested, like the USSR former satellite countries are contested. Does that add a little bit to it?
Yeah, yeah. I'm just, I'm not sure that, when we talk about control of the Caucasus, it's just I don't see any one entity really doing a good job. Russia's tried for years. Iran's trying,
No, they're not
Turkey's
going to.
trying.
I think you're right. I don't think anyone can really control it. So it's shared control. It's a cooperative. It's a cooperative. Like you don't own the Caucasus, but you put a pay toll on the Caucasus. It's kind of like I mean, it is what it is. I think it's like the hole in the donut, that needs to be domesticated, if not controlled, But I agree with you. The Caucasus are in the center of the new Silk Road. Right, exactly. They're in the center of everything that matters to those people over there, or what China had referred to as the Belt and Road Initiative. Notice that Pompeo spent a great deal of time there before the end of Trump's administration in 2020. Thank you, Presley. That's interesting. Yeah, and it's an interesting area. Vampires and all that shit.
If I can
At the
add,
end of the Hold
I
on,
can
let me read what Andrew has here. At the end of the day, based on everything stated and reported, nobody wants Iran to go nuclear. Yeah, exactly. The Shia-Sunni split is important there, right? I mean, if you're not, I think most of us are familiar with this, but the Shia-Sunni split, simplifying, is the Shia are papists. The Shia are Catholics, and I mean this in terms of the vertical hierarchy, and the Sunni are less theocratic. So it's kind of like vertical integration versus horizontal, and they don't get along. And it looks to me like over the years, the Sunni have slowly become westernized in terms of military, in terms of how they view religion. I mean, I don't mean they're like us at all. They're still beheading people and imprisoning women, but the Shia are still theocratic, and they're evangelical. They seek to spread the religion. And to your point, the satellite areas where they're Shia are where their strongholds. And as those are broken, Iran loses its power, its ability to project power. Yeah. So who had something to say?
it was Iggy. I agree with you in general on Sunni and Shia. It has to do with basically who had the rightful, who were the rightful heirs to Muhammad, right? Is
Yeah.
it from,
Right. Yeah.
is it from
Yeah.
lineage, or is it from people that did that's the split. And
Yeah. It's like kings versus elected, that type of stuff.
and then I
Right.
would argue in the Middle East more general, there's three major groups, right? You have the moderate Sunnis, which are the ones that are allied with the West. Then you have
Right.
like the radical jihadist Sunnis,
Right.
which are the ones that are causing a lot of the a lot of the problems, and a lot of them are allied through Iran, but also through countries in the West. It's not just like Kuwait.
Right.
Used to be very Western, and now they're a lot more jihadi with their money, and so is
Right.
Qatar. But again, I don't know. I'll let historians over the next 50 to 100 years parse out who was really controlling that. Like what was happening, say, 100 years ago during World War I, when the West was really trying to get the Germans and the Turks out, right? So
It
that's
all started with the British, man. The British would go in and and give guns to the people that were in the minority, had them overthrow the majority, and then it just would go back and forth over and over again. I mean, the
Yeah,
British.
and then the one other thing that I wanted to say about the Caucasus, right? And I'm paraphrasing, if not quoting, from Brzezinski's book in '97, The Grand Chessboard. But my understanding from reading that book was that the Caspian was the greatest geostrategic prize in the entire world. And so that means not just the sea itself, but the military and the trade routes and everything that surrounds it on all sides.
Right.
So
Right.
yeah.
Yeah. And for those of you not familiar with Brzezinski's book, if you hear what Iggy is saying, you're saying, how could it be the most important in the world? If you read Brzezinski's book, his book says the most important landmass in the world is Eurasia. And he makes a big deal of saying you're used to looking at a globe and you see North and South America and he goes, if you turn the globe upside down, or the map, I should say, upside down, you realize that the landmass of Europe and Russia and China, or just forget China, just Europe and Russia, is massive. And the center of the world isn't the Atlantic Ocean, it's dividing us from Europe, and it isn't Europe, meaning dividing the North and South America from Asia with London in the middle, like Europe in the middle. The center of the landmass of the world is right in the middle of Eurasia, and that is roughly around the Caucasus. So the point is, I think the book is fascinating because when I read the book, not as thoroughly, I would say, that Iggy did, I was focused on the fact that holy shit, it's not just the effect of, what's that effect, the Mercator effect on the map. If you turn upside, if you look at the world upside down, we look like a little island compared to that area. And I go, oh, shit, we're never going to be in a, that's why I've said recently, we'll never be in a land war again. You know, we just can't win. It's too big over there. We don't have the army. We just need to control the sea and the air. Anyway, so that's why Brzezinski is so focused on the Caucasus. He's like, look at this landmass and look at where we live. He goes, this is the future. You know, anyway, I wanted to add to that because I think that's a really important point that he made. Anyway, thank you. This has been really, really, really good.
And let me I hate to throw one more thing in, but I think there's one more like kind of feather in the cap here that I think kind of makes this understandable. And I hope I don't lose it here before I say it, but it's that I think I'm going to lose it. I'm going to pause it until I can remember it, but I want to. It's a really important thing that kind of sums it all up again. So I'll come back.
Oh, you mean you want me to continue and come back to it?
Please, please.
Okay, I thought you were referring to your technological thing. All right, good. All right, so let's go through it. And all right, so we did that. And let's see, close that. Okay, so this is based. So the sum of this whole thing is this: the 5 days covered are a non-event. The behavior is normal. There's nothing special. However, I note that whether they're right or wrong, I see an increasing correlation between the long swap dealers doing whatever the macro, I call them the other reportables do. Other reportables is macro discretionary mostly, but they're not playing a lot. But right, so that's the only thing fresh I got out of it. Silver. So here's silver. During this same 5-day period, silver rocketed. An unchanged day, a big up day, a pretty big up day, another huge up day, and then a down day marking a top or a bull flag or however you want to look at it. All right, so those are the 5 days. So that's basically, that is, again, not a trend week higher. It's a normal variation higher. And I think it's significant. We don't do much silver at all here, but you know, and silver's not as easy to go black and white. It's like a semester of learning about the behavior. But right now, it's pretty easy because the market's trending up, trending down. So here we go. The biggest player on the week were the swap dealers. The swap dealers got short 4,372 contracts. In a rallying market, they sold. They sold a lot. You know who else also sold? Producers, the other purple rectangle. They sold 2,200 contracts. That's odd. Producers, I mean, it's only a snapshot, but the history that I know is that producers will sell in a rally, but they won't sell. They don't really have as much to sell in silver as they do in gold. They're not as consistent. So this might be some chunky real business that they sold because we went up to an area that we were at before. So if we get through this, what I'm getting at is the producers have real selling in this area because it's very rare that we stay here. We've been hitting it and coming off, hitting it and coming off, right? And that's because there probably is some sort of production-related hedging going on there. And the swap dealers are also comfortable selling it. So who bought from the swap dealers? Well, the red ones first. I'm sorry, not the red ones first. Who bought from the swap dealers? Well, the short managed, let me get these here, right? Short managed money covered their shorts in the rally first, right? Who else? Short managed money on the other reportables covered their shorts. Boom. Well, I matched them over there, but that's it. Who got long? Well, managed money, regular plain vanilla managed money got long, right? I don't know why I put this in red. I shouldn't put this in red. Other reportables got long. Oh, I know why I put it in red. I put these in red because there it is. Other reportables and long producers, long swap dealers doing the same thing. Okay? So who sold? Well, short managed money covered, long managed money added. Who sold? Well, long long end users sold. And so basically, this is also normal. There's nothing abnormal here. Shorts covered, longs piled in, longs added, shorts covered, and banks sold a lot. The only thing I would say is, although it's early, I would say this is a big number, and this is also a big number. And if this is a big number, then, and it makes sense, there probably is real selling there. Did we get through it? We haven't gotten through it yet. You'll notice that we're kind of doing a little bull flag thing. The question is, are we done rallying? I don't know, but we did not get through it. So if we go to the options, this is what, now I made the comment that dealers are a little bit nervous. Here's what I noticed. Again, it's a snapshot. It's not, I don't have the flow or the context. Short swap dealers, they sold 4,300 contracts in the rally. They also bought calls. Now, if you're going to tell me that they're long calls and that's gamma, no, I don't think so. They bought calls. These guys bought calls, and that's dealer call buying scramble. That's dealers saying, all right, if we're going to sell futures, I want to at least buy some calls and be stopped out. Why am I saying that? Because that's how it works, especially when you got your ass handed to you for the last year and a half selling futures and not buying any options. So who sold these calls? Everyone sold the calls. That's why I use the word scramble, meaning there wasn't anyone out there natural call selling. They had to look for these calls. Look, these guys, they bought 200 deltas in a rally. That could be gamma, I'm not sure. These guys, they bought, so who the hell sold the calls, right? These guys did. These guys bought from producers. They bought from other swap dealers. These guys bought, it's only 700 contracts. I'm not trying to say it's life-changing, but they bought calls. They bought them from these guys and these guys. And these guys trade with each other. So these guys. Sounds really professional. Anyway, so that's silver. I don't need to be that. I want to be out of this. How do we get out of that? Here we go. All right. So what did I write here? Short dealers are not happy here, meaning they're selling it, and they see producers selling or somebody on the producer side who's selling it, but they're buying calls too, so they're not completely happy with it. All right. So that's that. I'm not going to answer questions on this for a little bit because I want to get through some of this. All right. Open interest. Okay. Here's the open interest chart. Here's Randy's open interest chart. Oh, did I just freeze? You fucker. Do you guys still hear me?
Yes.
Oh,
Yep.
my mouse froze for a second there. All right. So I wrote this down and it's kind of accurate, but it kind of goes like this. Here's the open interest. All right. Really got low. This is where I started saying, "Oh my God, it's the end of the COMEX," and it's probably still the end of the COMEX. But this is very good, and it didn't go up from 5,000 small CTAs buying. It went up from the big boys buying. Does that mean it has to go up? No, but it means that we will go up if there's no bearish news. See, these guys buy for a reason. There is a war. If there's no news that comes out that says the war is over, then they're going to buy more. They're going to buy dips and they're going to buy rallies. And so this market is now in its normal behavior. There's a reason for the market to go up. There's buying on the sidelines that some of it's looking to buy the dip, some of it's looking to buy the rally. Probably no one is buying unchanged, but that's the point. All you need is one guy to buy unchanged and the market will start to drift higher. So I view this as very constructive as a trade. Not, new all-time highs, although I do think that's going to happen. So I did a back of the napkin quantification. All right. Where is that? How do I get rid of these? I hate Zoom. All right, so here we go. All right, so what did I write down? What chart should I have up for this? Oh, I know what I should have up. I should have this. I should have all right, so here's Randy's spreadsheet. And again, this is back of the napkin. This is to give you, the idea here is, oh, geez, we're in uncharted territory. What do I use for numbers? You know, like no system, Fibonacci, whatever have you. So I'm going to use a volume one. This is one I use for volume. And it's the way that you make sense of the current behavior. And you say like this, you go, where are they? I said, these last 3 days are macro discretionary getting in. I add this day in because open interest went up as well. And I do the total on the amount of contracts that open interest went up by, right? And I rough it to 25,000, right? So 18 and 8, 18 and 9, 27. I want to call it 25, right? So 18 and 6, 24, 20. So it's like 26.6. All right, so let's call it 20, 25. I mean, you should be exact when you're finally looking at your numbers, but this is how you start. So 25.5. What did the market do? This is going to like freak you out, right? This is where I go, oh my God, I'm really bullish now. What did the market do? How much did the 20, call it 27. I don't want to be too bullish. How much did the market move on 27,000 contracts coming into the market? Fresh money coming in. Bought it, market went nowhere. Bought it, market went up. Bought it, market went up. Bought it, market went up, right? How much did the market move? It moved $104. That's a fucking lot. That's a lot. Okay? That's, I'm like giddy right now. So the reason that's the last thing I did. The rule of thumb is, it's not rocket science, but it really is helpful. The rule of thumb is, all right, well, then you go back to, then I went back to this chart. And I went, all right, so we're looking at the open interest chart that I had up of Randy's, right? And what I do is I look at, I want recent behavior, not old school behavior, but I want diverse recent behavior. So I'll do things like this. I mean, I did different ones. I'll just show you a couple right here, right? I went, open interest moved this amount. How much did the market drop? Right? Open interest moved this amount. Actually, this isn't good. This is when we had the delivery problem, right? So open interest moved this amount. How much did the market move? Open interest moved this amount. How much did the market move? Right? So it's a peak to trough thing. And I came up with various little things. I looked at a lot of things. I was like, open market went down to here. Open interest went down to here, right? So open interest went from here to here. Market went up. I ignored this, okay? Because this was the banks really covering, right? This is, the bank's doing some covering. So the market's going up as open interest is going down. So it's overlapping, but it's in there, right? All right. So anyway, here's what I came up with. I don't have the data in front of me. If this is what I wrote, so you saw me do different numbers. 25,000 contracts equals $105. So 25,000 contracts equals $100 of rally, right? That's not shorts getting out. That's longs getting in. So how much, using that math, does 50,000 contracts move the market? And the answer was $200,000, $200. So that's your napkin. And then once you take that, because this is in the mode that we're in right now. So that's the current events. The first 25,000 moved the market up $100, right? What will the next 100,000 move? Now that's not true. The next 100,000 will move us $100. It could move us $500. It could move us $20. Depends on where the selling is. And right now there's no selling. I'm telling you, there's no selling again. Nobody wants to sell this. You're going to see the gold silver ratio probably go back up to like 100, 102, 110. Who the hell knows? But this is what people do. It's crazy. So then I took that number and I said, all right, the next 25, then I looked at various things. Now, I didn't do it scientifically, but Randy, this is the type of thing I think you would want to look at too. In the past, we looked at, in the past over the last, say, 18 months, When gold had 10,000 up, where was the market a week later? Right? When it had 20,000 up, where was the market a week later? Also, I used to look at when we had 10,000 up, what did the open interest do the next week? Right? So we just had 20,000 up. What did the market do? What will the next 20,000 do? It probably won't rally the market $105. This is me throwing water on it. The first 25,000 contracts rallied the market $100. The next 25,000 contracts will probably rally the market less, but the chances of it rallying the market go up, meaning we're already moving. So it may take 100,000 contracts for the market to go up another $105. But you know that if the funds are going in, it's going. You only get worried about this rally now, forgetting about the war part. You only get worried about this rally when you see this. 5,000 contracts, market, right? Let's break it down. 25 into 104. So 5,000 contracts, and if $25 makes the 25,000 contracts makes the market rally. So what's 5 and 2? What's 5 and 100? 5 and 100 is 20. Okay. So 5,000 contracts makes gold rally $20. That's the math that I just did, right? 5,000 contracts makes the market rally $20. The next day that we have 5,000 contracts, you just create a ratio. 5,000 contracts come in the next day. What did the gold do? It went up $30. Well, now you know it's getting worse for whoever's selling, not better, right? 5,000 contracts come out the next day, and gold only goes up $10. You say, the selling is getting comfortable selling again. They're selling above. And it could be, Scott, macro discretionary getting out now, right? This is like the whole behavior, right? We're creating a cheat sheet here. So on the first 5,000 contracts, the market went up $20. On the second 5,000 contracts, and you're creating a sine curve here. And by the time you get to the third 25,000 contracts, the market's going up $30,000. $30. And then by the fifth or sixth 5,000 contracts, the market's unchanged. And that's when you get your fish hook the other way. Open interest up, open interest up, open interest up, open interest up, fuck, and it falls off the table. So that's normal gold behavior. But the numbers are so much bigger now because, number one, the bank swap dealers, although they're allowed to play, they're not playing like they used to. So that says to me that the market will breathe more, number one. Number two, in no particular order. Number two, Goldman has long options and they got their foot on someone's throat. I don't know who, but they do. That's completely speculation, but you've seen the reports I've done on the exotics that they have. Number three, the macro discretionary have completely destroyed is not the right word. They've distorted the market. So they're going to come back into it quicker. They may not put as much in as they did last year, but they're going to come back in quicker. And so for these three reasons, the bank market makers are going to let it breathe more because they don't have the selling, number one. Number two, they've all got, number one, corollary, they've all gotten so burned that they're now buying calls in silver, opinion, based on the fact that they don't want to get burned again. So that's number one. Number two, I forget what number two is, but you've heard them all, right? So that's, I'm just kind of jumping around here. The caffeine is kicking in. If the progression of behavior remains linear, 5,000, 5,000, or 25,000 equals $100, well, then the next 25,000 should equal $100. And we don't need to look out that far. All we need to look at is the next 5,000. The next 5,000 contracts, what did gold do? It's unchanged. Oh, shit, that's not good. The next 5,000 contracts, what did gold do? It's up 20,000. I'm sorry, it's up $20. That's good. $30. That's really good. So I'm giving you, if you're long and you're thinking about getting out, that's what you look at. For me, I'm long silver. If gold comes in unchanged tonight, I'll buy it. And I'll buy it with that metric in mind. So the next day, if gold's up $2 and open interest is up 30,000 contracts, I'm like, oh shit, that's not good. I mean, it could continue going up, but That's not what I'm looking at. So there's your back of the napkin. You're like, how much higher can this go? Well, another 25,000 contracts could equal another $100. That's it, right? So why am I saying that? Because my other math was, I did a 60,000 contract move. That was like, my average was in this new era of gold, not the old era, 60,000 lots at the best lead to 200,000. And at the worst, it leads to like $50. So that's basically it. You could also look at the short side, which I would recommend. And the short side, looking at the short side goes like this. When the banks covered their shorts for that, where is that chart? Maybe I can display that. Yeah, here we go. Here we go. All right. When the banks covered their shorts, now this is not the funds in charge, it's the banks in charge. When the banks covered their shorts, that was here. Let's call it the here. That was the open interest going from, correct me if I'm wrong, Randy. Basically 600,000, right? We're right here.
Is that the first of the year? So
That's, yeah, right after the first of the year.
and,
Right.
yeah, about 600.
Right, so about
590.
600,000. And I'm not going to go all the way down here. I'm going to do this. This is actually, this is, they covered here too. This is them covering too. In fact, let's do that. Let's go from, hold on. All right, let me just clean this up for everyone. All right, so here we go. If you do the reverse, now I'm saying 25,000 contracts in, 25,000 contracts in gets the market up $100. Let's do the reverse when the funds aren't in control, but still we know someone is playing. The banks start covering at roughly 600,000 contracts. And it's not all banks covering, but the shorts cover, and I'm going to say here, right? Let's say that here. Let's say that's it there. And then I'm going to give us a price to be fair. There, right? And that price is the low of the rally. And this price is here. So call it the first 2 weeks in January versus this. Do you know what that looks like, Randy, or should I pull a chart up?
Hang
Like,
on,
what's this price right here, roughly? And what's this price right here?
So the date is January. We're about
Yeah,
20,
the first one, the January one right here. Call it,
about
what was the
20
price of gold when the open interest is on the highs? That's the question.
2782.
2782. All right, good. 2782. By the way, I haven't done this before. I just eyeballed it. And what was the price of gold? When gold dipped violently, I'm going to say this is January, March, April.
About May 14th.
It might be closer to the beginning of, yeah, it looks like that. It looks like, what was the lowest gold price that you, I could pull it up on a chart.
Yep.
Let's pull it up.
3190.
3190?
Yep.
All right, here we go. Here we go. All right, so we got a change in open interest. Thank God I didn't bet you guys. A change in open interest from here to here, and a market that goes from 2782 to 3190. So call it 2780 to 3200.
400 points.
Yeah, 400 points, right? So that's a $400 move, and the open interest goes from 600 to 430.
440. Yep.
440. That's your green. That's your old school line, right? From
Yep.
when we started doing this. So the market goes from 600 to 440, right? So let's call that 160. So 160,000 contracts. I'm going to call it. What do we say? 400.
Yep.
160,000 contracts. 160,000 lots of open interest, not contracts. is to $400 as X is to $100, right? I'm trying to see if there's a correlation between my 25,000 on the way up and the on the way up with the open interest coming out, because we're looking at a pure open interest correlation. And the answer is 160 is to 400 as, so it's what's 1600, 16,000 divided by 400, which is 40.
It's 40K per 100, roughly.
Right. Okay.
40,000
Thank you. Right.
per
Exactly.
dollars going down.
So in this rally, the market in this rally, it took 25,000 contracts to rally us $100. Okay. In that rally, it took, and you could see it's more of a panic rally, right? It doesn't look like a panic, but it ended up being a panic. In that rally, it was 40,000 contracts being closed, being bought, but being closed, that rallied the market $100. So let's say that it's between 25,000 and 40,000. Now I want to do this out loud. I want to make this less euphoric. So I want to go instead of this, just work with me here. Instead of going for this home run down here, I want to go from here to here. I'm going to make it worse. All right. The price of gold before the torrid April run-up was what? Right before the torrid April run-up, like April 5th, when it started. Can someone pull that price up for me?
Yep. About 30. Wow. 30.50. And then there was a huge drop April 7th. It dropped down to 29.80.
That's what I want. So
And that's 4 days after the tariff announcement.
Right. Okay. So just to give everyone a feel for what I'm doing here, using the analysis that I did, 25,000 contracts is $100. Fine. Okay. Then using this analysis from here to here, I said, 200, how many contracts was it?
40,000.
100,000, something like 160,000 contracts. 160,000 contracts was $400. And so I'm saying to myself, based on my understanding of how these markets work, that's too much. So let's get rid of this area here, because this is where things got really goofy, right? Let's just measure this area. This peak in open interest to here against this move from here to here. And so that goes from 2780 to, what did you say? 2980, Randy?
Yes.
Right. So 29. So that gives us $200 on a change in open interest of, it's still 600, excuse me, down to, let's call it 475. So 475, so 125. So a $200 change on 125. That's still big.
It's
right?
60,000, about 62,000
$62,000 per 100?
per $100 move. Yeah.
Yeah. So, all right. So there you go. So at the low end, on this recent end, 25,000 gets you 100, right? At the high end, during this aggressive panic, not panic, but orderly panic. This is, believe me, this is what London was shutting down when this happened. Comex was on liquidation only. So let's say that this is the outlier. 60,000 gets you 100. I'm sorry. What did you say, Iggy? I'm fucking spacing out here.
60,000 per 100 in the new one that you did, the third one.
Okay, so that's actually less. 60,000 contracts got us $100 higher, and in this move, 25,000 contracts got us 100 higher. So I want you to assume that 60,000 got us 100 higher is more normal and 25,000 is aggressive normally. You follow me? So breaking it down, 5,000 contracts should get us up $20 if we're aggressive. And what's 6 and the 10? 5,000 contracts should get us up how much in the less aggressive one? So it's 60 for 100, right? So
$8,
five,
$8,
$8.
$9.
Yeah, right. So it's 12 and it's 12 into 60 is 5, right? 12 into 100 is 96. Yeah, right. $8. So call it $9. Call it $8, right? So if you see 5, I'm creating a candle in the darkness. The next 5,000 lots of open interest, if the market rallies $20, it's on. Like it's still on. If the market rallies $8 or less, it's fading. Anything in between, you're happy. You follow me? So that's like a trading sheet I just created. And those are very helpful because at the end of the day, you're like, I made a lot of money. What's going on? Open interest went up by 20,000 contracts, but the market only rallied $5. It's time to get out. You understand? Everybody got that? Thank you, Iggy. Thank you for the math there. I'm old. Let me look at the questions here. If you plan to be in conflict with Russia for an extended period of time, you need to carve a path around it. Meaning carve a path around the Caucasus.
Well, so you got to get around Russia if you want to. If you're so Iran is important, Syria is important, Turkey is important to
Right.
connect.
Right. That was the Hitler problem, right? He couldn't get around that. Yeah. I
Well,
agree,
he
Jonathan.
got stuck in Stalingrad and his ego got in the way.
Yeah.
And he lost Army South because he decided he'd fight over the name Stalingrad rather than going for the Caucasus. That's what happened there.
That was ego. Yeah. All right. So all right. So Randy, back to this mentality. Who was going to? Yeah. So Randy brings up a point. I just did all the math, or not the math. I did the conceptual math. Now let's go into this. Who's going to fucking sell this here? Nobody is. Nobody is. So I'm hoping silver is going to go up, which is bad. I should just be long gold now. I mean, that's it. So I agree, Randy. Who is going to short this here? Tab 19 is MD position.
Macro discretionary.
I was going to say.
So what I did, you want to pull it up?
I think I'm doing that now.
And I'll talk
Is that
you
this
through
here?
it. Yeah. Yes. So
How'd you
give
do
you
this?
a quick rundown. So the upper chart is total open interest, the one we've just been looking at for the last 20 minutes. The lower chart with the green and the gold, that's the weekly COT numbers. And in this case, I've just plotted the non-commercials. Okay. And it's the dates don't match because obviously it's weekly and daily. But
Right.
you can see the right side of the chart is a little bit closer. And so the non-commercials, the green line, have bottomed and started up, just as you were trying to prophesize a little bit that these guys just might be stepping in right now. And if you look at the upper chart, which is the total OI, there it is bottoming and starting to roll up. So that's evidence to your theory.
Yeah. This is interesting. I mean, obviously the green chart and the red chart have similarities in direction, but the correlation between them, Randy, meaning, how we look at non-commercials, who's long and who's not long, and commercials, right? But if you look at the total open interest in non-commercials, you might create an oscillator, meaning, I mean, I'm just making this shit up, but here's what I mean. Like, for example, see this rectangle here? Red's a bad color to use here. Let me see if I can change it. I was going to use white. What a moron. That looks different enough, right? Let me make it. narrower. Oh, good. I can make it narrower. All right, so here we go. Hear me out. See this dip here in open interest? I'd have to draw a straight line down, but this dip here is, let's for argument's sake say, not accompanied by the same dip in macro discretionary, or I'm sorry, see that? That's not them selling. You follow? That I'm gonna make sure.
Yes.
Can you guys hear me?
Yeah, it's almost like they're following because you do
Well,
see a dip a few days
well,
later,
it
right?
depends on where you are in the curve, James. I hear your point. The concept. Let me make a unifying concept clear here. Without looking at the chart, macro discretionary gets in before everyone else and gets out before everyone else. So they look like they're following on the last part of this curve, but they're actually leading. Here's what I mean. Remember when gold rallied from, here to here while the open interest went from here to here? That was macro discretionary selling the rally. And as they were selling it, smaller funds were getting in. So the non-commercial longs were getting out. See, this is good, Randy, but wouldn't it be even better if, I'm not giving you work to do. I mean, you do enough, right? But it would be even better if we could look at the, if we could just see who the macro discretionary players were, it'd be even better. The question is, maybe the other reportables are the macro discretionary. I guess we'll see next week. I mean, generally they are, but not always. I feel.
I don't know. I don't know how to plot that because I just pull the aggregated
Yeah, yeah.
COT.
I
I don't
agree.
go into the in-depth one that you guys
Of
cover.
course. Yeah.
So I don't know how to play with that yet. I'll think
Yeah,
about
I'm going to start. You know what I'm going to start doing is for shorter term trading. I'm going to look at the commitment of traders now that I've noticed it. Uh, um, swap dealer longs with non-commercial longs. So basically, all the longs. No, that doesn't work. It's too noisy. All right, so you guys get the idea. Maybe you don't get the idea, but the idea here is that the open interest drops from here to here, and the non-commercials bottom before the open interest bottoms. And this rally, this part right here, it parallels. I'm not going to say that they're early, but I am going to say that if the whole rally is non-commercial longs getting in, and we see that it's not the regular plain vanilla, I'm fucking making this more convoluted than it has to be. The bottom line here is the non-commercials on the macro discretionary side, that half of the non-commercials, they're the most important people. And the best way to look at it is the way that we discussed a year ago. Whenever there's over 10,000 contracts in the market or close to 10,000 contracts, that's macro discretionary. CTAs don't buy that amount. Regular hedge funds don't buy that amount, and that's it. So there you go.
Can I ask a clarifying question, a teachable question in these
Sure.
two graphs?
Yeah.
So we've been covering this in different ways and different angles and tops and bottoms and all that. But when I look at the top graph and I see that back on the left of the graph, we started at 400,000, right? And let's just say
Right.
a price of whatever that correlated to at the time. And then we do a full round trip at open interest to where we
Right.
were just say a week ago.
Yeah.
And yet I see the price went from, probably what's somewhere down around, 2,300 all the way up to 3,300.
Yeah.
So
Yeah.
even though the whole thing round tripped, and again, I've heard you make the point in previous sessions that
Higher
that's
lows.
great for being long the metal because all the junk is kind of flushed out. And now new longs and new money can come in. But
Right.
I'm trying to reconcile that kind of thought process versus what we just did with the three scenarios of the 25,000 giving us $100 and the
Okay, yeah,
$40,000 selling. I'm having a hard time reconciling this.
yeah, okay. I don't think it's supposed to be reconciled, and here's what I mean. For everyone out there, one of the things that we noticed early on is that the expression that I used to describe it was the floor keeps getting raised. So to graphically draw what Iggy just said, where is that? Oh, there it is. This is going back to 23, and so we would do this. We would say open interest from here up, and then back to here. What did the market do? Right? Let me go with the bigger one again. Yeah, okay. So the open interest goes from here to here in a round trip, and the market goes from here to here. Open interest goes from here to here in a round trip, and the market goes from here to here. So higher highs in open interest. I'm sorry, same open interest low or close to it. I'm trying to keep it apples to apples. Randy's line there gives us a higher high. Touch here, market there. Touch here, market there. Touch here, market there again. Touch here, market higher. Touch here, and so you're getting an open interest. You actually had higher highs in the open interest for a while too, but you're getting an open interest that every time it touches a spot, the market's higher, higher, higher. And we described that as many ways, but one of the ways we described that as was the floor was being raised, and I said that was central bank buying, raising the floor and slowly forcing the bullion banks to cover their shorts. Now that is contradictory, at least somewhat, with what I'm saying right now. And I'm saying use the volume to give you an idea how the market should move. Right, Iggy? Am I phrasing that right?
You are, but I'm going to complexify it a little bit, complicate it a little bit when you're done explaining this. So yeah, go ahead.
Okay. All right. So the reason that, I mean, it's contradictory, and I'm not going to say it's not contradictory. I'm giving you levels for tactical short-term trading, not longer-term trading. So using the higher highs in the market as the open interest bottoms, we should just be long. Nothing has changed. But I'm giving you the tactical comment when I say, on a day-to-day basis, is this cycle over or not? That's all I'm going to say. I'm saying, I'm giving you numbers for the next week, right? I'm saying to you, I don't know how much the market's using the big picture comment, Iggy. It's like higher highs in the market every time the open interest touches this level. Says to me, keep buying every open interest cycle, right? Until it breaks it, right? So that's like anywhere from 1 month to 6 months in a cycle, right? And now I'm saying within that cycle, 5,000 lots, what did the market do? So the cycle itself goes like this, right? And within the cycle, you have these little sine curves. Getting momentum, losing momentum, getting momentum, losing momentum, right? So that's what I'm talking about. So if you're going to swing trade it, my things are important, meaning swing trade it mean I'm long and I'm going to get short, I'm long, I'm going to get out. That's all I'm saying. I don't want to let that be a macro guiding tool. That's just a short-term trading tool. So what's your complication?
Oh, it was just about on whether they contradict each other or not. But and then to review what we just learned, say 10 minutes ago on the other two graphs, we had the first scenario I think was like $25,000 or 25,000 contracts boosted us $100,
Right.
and then we had the 40,000, and that was long 25,000
Right.
long
Right.
boosted
Right.
at that, and then we had the 40,000 short
Right.
when open interest was declining, I should say.
Right.
That was boosting us by whatever that number was. I'm forgetting the numbers. One was 25,000, one was 40,000, one was 60,000, and then we did that third scenario that was we did that third scenario that was 60,000. But was that conservative, or that 40,000 one where open interest was declining so much? Was that just like part of that one-off kind of anomaly that happened because of the scramble at the beginning of this year, and that normally we wouldn't see that? We'd actually see more gold price coming off?
No, I think that's a question that anyone who's looking at what I just looked at would have to ask. And the question is, again, for everyone else as well. That example I used of the open interest coming in is not normal. at all for our analysis. The first reason it's not normal is because, well, it's shorts covering, not longs getting in. It's contrary to how the market normally behaves. So for that reason, it should be looked at skeptically. The second reason it should be looked at not skeptically, but as an extreme example, is because the banks, I believe everyone had to cover. And so, Iggy and everyone, that example is the absolute extreme in my mind. You follow?
Yes, if you're asking me. But that was
I'm asking you as a proxy for everyone else. Now,
yeah,
if I wanted to,
I suspected that was the case, and again, I'm sure for we had the the run up, say from 2016 to 2020, that
Right.
would probably be more in that quasi bullish scenario, and then that
right. But in fact, if we wanted to do the math, Iggy, yeah, I'm sorry.
No, go ahead.
If we wanted to do the math properly, see, I gave this example because it was a big move, it was clean, and I knew what was going on, right? But if you wanted to be proper scientifically math-wise, remember, I'm always doing a back of the napkin thing. Scientifically, what we would do is 25,000 gets you $100. Now let's look at that every time open interest goes up, not down, right? Open interest goes up 50,000 and the market moved $20. Like, we should be looking at, if you want to make it purely apples to apples and take this back to the napkin concept and really do a regression analysis, which would allow you to create an algorithm or risk management tool, you would say, when the market is functioning normally means funds getting in makes the market go up, funds getting out makes the market go down. When that is happening, what is the behavior of the market when 5,000 contracts go in the market? Okay, that's what I would say. The reason I picked this is because it was so close. And even though, and here's why I'm kind of liking that assessment, even though it was, number one, extreme, and number two, completely backwards, right? The funds were selling and the banks were buying. It was a matchup. It was like head to head. And so I'm not saying it wasn't crazy. It was crazy, but it was 60,000 contracts, or whatever it was, 1 billion contracts getting out and the market rallying, $400 or $300 or two. The point is, I wanted to use that as the absolute upside of what we could expect. That was the home run. Could that happen? Here's the thing, Iggy. Could the bullion banks be made to cover shorts again? Yeah. And that's what would happen. So that's my thought process. Do I think they'll cover shorts again? No, not like that, unless we take metal again. So I really think I'm giving you the upside scenario of, that type of behavior. But the reality of it is, I think we're more, if we were to test only buying coming in over 5,000 contracts, what does it do to the market in kind of like a rolling average for the last 3 years? You'd probably come up with something like 5,000 contracts is $10. You probably would. I really think you would, because I've studied that for years. Like, oh, how many longs? Oh, the market was at $20 today. How many longs got in? 5,000. Wow, the market moved a lot. Looks like we're at the beginning of freshman. See, everyone who's not familiar with this, the reason I cared about the volumes and open interest is because it was a sign of early or late entry. So when a market started to move higher, kind of an official concept, when the market started to move higher and new longs came in, I'd say the market rallied $20. How many longs got in today? 5,000. That's good. Second day, the market moved $20. How many longs got in? 10,000. That's not good. Double the volume, move the market the same amount. And so that would tell me the market was topping. So to bring it home, the volume for me gives me an idea of how confident, how much money is allocated into the buy side. And conversely, or related to that, how comfortable the banks are selling. Now, why do I have such a big, complicated concept about this? It's right. And I'll tell you why it's right. When I was on the floor, I was a silver options market maker, And my broker who handled my futures, he handled my layoff. I do options here, and I'd say sell 40, and he would sell 40 contracts for me over there. One of his customers was at the time he was the head trader for JP Morgan. Okay. And my broker who was handling my silver futures, he got investigated by the CFTC. And the trader that was his client got investigated. I wasn't affiliated with them at all yet. I was like, oh, look what the rumor was going around on the floor. Oh, I'm not going to say his name. So-and-so is getting investigated. Him and his customer, Joe, which may or may not be his real name, are getting investigated for, I'm like, what happened? What happened? Well, here's what happened. The broker got a big order, an order to buy 1,000 silver contracts. Huge order back in those days. Silver was trading at like fucking $4. Okay. And that's the kind of order that the broker had discretion, meaning he was like, here's 1,000 contracts. You have all day. Take your time. And then it turns out that I found out later, right? This never came out in the investigation, but I found out later. It turns out the other customer on the phone said to him, we'll call him Joe, said, hey, I heard you got a big order. And the broker said, yeah, I do. He goes, how many? I can't tell you. Well, tell me when you have less than 200 left to buy. He goes, okay, click, hung up. So the broker starts buying 1,000 contracts, the first 100. The market's going up a little bit at a time. This is behavior that justifies this analysis. The market goes up. He buys 100. The market goes up. But he's the best broker on the floor. Buy a little bit here, buy a little bit there, buy a little bit, doing that, right? And now he's got 200 left. So the broker calls up the other customer and says, I'm almost done. I have 200 left. The other customer says, okay. He goes, I'll sell those 200. Now the broker's in the ring, right? So the broker's like, I'm 5 bid for 200, 5 bid for 200. No one will sell it to him. So the market's like, I'm 6 bid for 200, I'm 7 bid for 200. And then his customer on the other phone comes in and says, sell him. He goes, 7 bid at 8, 7 bid at 7, 200 up, 200 cross, done. So the broker crosses the trade in-house. And that little story I had explained to me as a young trader. I met Joe and I'm like, what happened there? He goes, if you know there's a 1,000 lot order in the ring, you don't want to sell the first 100. You want to sell the last 100 because at that point, everyone will have sold everything they can and the market will be stretched. So taking that principle and that education, I apply it to options. I apply it to futures volumes. If open interest goes about 5,000 and the market moves $20, after a turn, we're at the beginning of a rally. If the open interest goes up by 10,000 the next day and the market rallies $2, we're at the end of a rally. So the whole official concept and the whole concept of open interest changes mirroring market moves tells you how much money is left. And I found that over the years that banks, market makers in the swap market that we're talking about right now, right here, those guys would be like this to each other. Hey, one of my funds is buying. How many is he buying? He hasn't told me yet, but he usually stops at 1,000. So what do the banks do? The banks go sell 100, sell 100, sell 100, sell 100, and then they sell the last 500 hard. So the first 500 the market moves $10. The last 500 the market doesn't move at all. All right. So it's the opposite of a VWAP trade. So the bullion dealers who see the buy orders come in like to let it move as much as they can. And then after they sense it runs up against some other selling above them, then they fill the order. Okay. That's why this whole explanation that I gave you came about. Smart dealers, Joe and the bullion banks, let the market breathe when the order starts. And then they cap the market when the order is almost over for multiple reasons. But I gave you the opposite, the obvious reason. Does that help explain why I talked about that tactically? That's the story behind this analysis that I like to do.
That's huge. As an instructor, you just brought all the points home. And yeah, I think I was getting confused by how it was going up still when all that open interest was going down. And then, but we had, in other words, it was, I don't want to say unreconcilable, but it was difficult for me to reconcile because two of our scenarios were, the price going up and the open interest going up. And then the other one, was
Right.
the open interest coming down and the price still going up.
Right,
Well,
but I want to
Iggy-
add something here that, hold on, I'm going to say this for you. Is this Scott talking?
No, it's Jim.
All right, Jim, hold on, Jim. Scott said something a while ago in the middle of this, Iggy. The dogma that I would preach here is that in the gold market, when the market rallies, that's funds getting in. They initiate funds getting in, funds getting out. They initiate the behavior, and the banks sell it on the way up and buy it on the way down. And so that's how that behavior is normally. Now, the behavior of that period where the banks were covering and the funds were selling, that's something that Scott kind of said when I was like, oh, this is the BIS selling it, just going to my BIS card, which is usually right, but didn't seem right. And Scott's like, maybe the macro discretionary, you're selling it. And this was at the very beginning of the run up. And I went, you know what? That could be true. I still stuck to the BIS as my go-to card. And maybe they were selling, but as this evolved, the market kept rallying and the open interest kept going down. I'm like, what the fuck? And that's when we all collectively discovered that the banks were covering shorts. A week later, you saw the bank open interest covering. The banks were covering shorts. And Scott was saying, well, maybe the macro discretionary is now capping the rallies and the direction is being driven by the banks. So, Iggy, it really screws up that metric from who's doing what. What it doesn't screw up is who's how much the market moves on volume. So generically, the market still moves X amount, but the players are reversed. You follow me?
Yep.
I'm just adding that for everyone else. I know you understand that. I'm adding that for everyone else.
Hey, Vince, because you used my name, can I add something?
No, you cannot. No, you
Okay.
cannot. I just fucking
All right.
complimenting. Go ahead, Scott. I'm fucking around. Go ahead, Scott. And then James, I want to hear what James has to say after that.
No, I just macro discretionary needs to call Goldfix. I mean, they're still waiting to buy it at the 200-day, I think, and there's a few that have come in now. So the question is, when do they come back in? Because they're going to get impatient.
Yeah, that's taking my whole theory that the macro discretionary isn't playing because I believe the market was capped during that inverted roll thing. Getting that my big picture stuff, which is I think probably right. The macro discretionary is not gone forever. Like there's no black and white with me. It's all nuance. The macro discretionary is a little bit more cautious, number one. Number two, they're also probably saying, to Scott's point, yeah, gold's had a great run. Let me know when there's a pullback to the 200-day. Let me know when there's a pullback that we got to pull back to the 50-day. Someone bought it. I think it was China, but they're looking for pullbacks. And then when the market no longer pulls back and makes a new high, the macro discretionary goes, oh shit, it never pulled back. Fuck, it's making a new high. I guess I'll buy some. And that's the behavior of every big trader in the world. Every big trader in the world does the following. They say, where's gold? 300. Okay. Where's it been for the last 6 months? Above 290 and below 310. All right. Call me when it goes to 290. Call me when it goes to 310 again. Call me when the range is being tested. That's how big players work. They don't like to buy a flat tape. They don't like to sell a flat tape because when you're in a flat tape and you're a big player, you can't get liquidity. When it rallies, they buy. Even though it's being bought, there's liquidity. For some reason, the selling comes out of the woodwork. Or let's say they're bearish. When it rallies, they sell. Big players sell. Big players act when the market's moving. Smart players may do one thing. Smart players may do the other. Now, when you bring it back to macro discretionary, call me when it's below 290. Call me when it's above 310. Now, gold has sucked for decades. And so they'd be like, where's gold? 300. Call me 290. Fuck that. Call me when it makes yearly lows. I don't care about it. I'm making too much money in the NASDAQ. Where's gold? 320. Screw it. Call me when it makes end of the quarter highs, end of the year highs. And so now we're in that situation. Where's gold? Gold's no longer at the bottom of their screen. It's at the top. Where's gold? It's near all-time highs. Well, I made a lot of money on that. I'll buy a pullback. We didn't get the pullback. Oh, all right. Well, I bought some silver. I'm okay there. Just call me when there's new all-time highs. No new all-time highs, boss, but we're off the 50-day moving average, and there's news coming out of the Middle East. Oh, fuck it, buy some. Now the 50-day moving average becomes the stop out, and this 200-day moving average pullback they're waiting for, they lose their patience. It's patience. And I'll give you a real example for myself. When I traded options, when I was trading size as a market maker, I would often have to do very big orders in the futures, and they weren't always profitable. So let's say I had risk on. This would happen in oil a lot. In gold, I just didn't do it. Oil was, let's say oil was trading like $60. And the market had just rallied $5. Okay? I'm simplifying it, but this is what happened. The market had just rallied $5 and it stopped for some reason. Now, at this $60 level, I have big risk on, meaning above 60, I'll give you a bad scenario. Above 60, I had to buy 100 contracts. Below 60, I had to sell 100 contracts. I had negative gamma. I was short a straddle. So for whatever reason, above 60, I got short, and below 60, I got long. And so at 60, I was like, I don't know what to do. I was shitting myself when these things happened, right? So it wasn't 60. The number was like 60 was the number, but I would add 10 cents up or down, right? So above 60.10, I made a decision to buy it. Below 59.90, I made a decision to sell it. That was how I was handling my risk. So between 60.10 and 59.90, that was noise. Now, why am I telling you this? Because that's exactly how macro discretionary operates. Between the 50-day moving average and new all-time highs, it's noise. But above new all-time highs, I'm buying the shit out of it. And at the 50-day moving average, I'm probably buying some there too. And so they look at the behavior and wait for it to test the range, just like me, but much bigger. And so when the market was trading 60 and I was short the 60 straddle, I would literally give my clerk orders to buy it at 60.10 or to sell it at 59.90. And I give him 2 orders. And my new clerk's like, what the fuck does that mean? Why would you sell it low and buy it high? I'm like, you don't understand. And then I would just leave the floor because I was stressing out too much. And I would say, call me if the market gets 15 cents higher. So macro discretionary is doing the same thing that Scott is alluding to. Oh shit, the market's $50 near the new highs. Well, I'll buy it on new highs, but not yet. Yeah, but there's war problems. Oh shit, just buy it now. And I think that's what's going on. So that's my war story for you. I gave you 2 war stories today. Anyway, I hope that helps.
The war story helps a lot. I wanted, if you don't mind, real quick, I wanted to go back to just parenthetically to.
Iggy, I do, Iggy, but I think I got to get back to James. James, what were you going to say?
Oh yeah, my bad. Okay, go ahead.
No, it's okay. Well, Britt and I think, are close to the same page. We had a lot of Chinese buying through all this and some central bank buying from I think the Poles were in it and the US was in it for a while. So, I mean, yes, open interest certainly had factors here, but there were also other underlying contributions to this rise in gold, right?
Wait, before I process this, which rise? The rise before or the rise this week?
Oh no, I mean over the long term, looking back to 23, as we watch these highs and lows in open interest, you're onto something clearly, but there were also other drivers in the market.
I mean, and I think that's good to juxtapose. So for example, forgetting this is for Iggy as well, right? Forgetting that whole banks covering shorts. If you look at, I'm gonna like paraphrase James and add something to it. If you look at the evolution of the market for the last almost 2.5 years, but particularly from March of 2024 through March of 2025. March of 2024 is when they started out. October. So you had just to give you the events. February of 22, gold spikes. The Fed starts raising rates. Gold sells off. October of 23, Gold bottoms, October 7th, gold spikes, and doesn't get stopped for a while. Then goes into December of 23, gold spikes, and goes sideways until February 28th. March of 24, gold doesn't look back. To James's point, between March of 24 and let's call it, to be fair, between March of 24 and November of 20 or December of 24, those months were heavily influenced by China buying. Is China still buying? Yes. Are they buying as much? Even though they're buying bigger than everyone thinks they should be buying, they're not buying what they're buying. So James's point is really valid. On the physical side, China is buying. At the central bank level, they're buying, but they're not chasing. It's not as urgent. Is China buying more? I think they are buying more. The insurance companies are now mandated to buy, but are they chasing? No. Between March of 24 and December of 24, something else happened. That's when I call him the Chinese hunt brother, Zhang Kai, he was buying and running in JP Morgan. That's not happening now. That won't happen again, at least not in gold. So James's point is really, really valid. And that is to echo, to put a finer point on what I've been saying, the easy money is over. So we're no longer the old gold, where 5,000 contracts, 5,000 contracts, 5,000 contracts, 10,000 contracts, we're done. Now we're 10,000 contracts, 10,000 contracts. Maybe it's 20,000 contracts and then we're done. I don't know. But that era, it's like an era between March of 24 and December was extremely rare and an exacerbation of normal behavior. So it may not happen like that again. That's a really solid point, James. You know what I mean? Like, so for example, this 5,000 to use that information to throw water on my analysis, 25,000 contracts. I'm sorry, right? 25,000 contracts got us $100 higher. That's a lot. And if it is, James, if it is the same ratio as we have between March and December of 24, I would be surprised. You know what I mean?
Yeah, I was just thinking as we're correlating, as open interest is diving, we kept talking about China buying physical. And so, yes, certainly the open interest, there were people in the US market, on the COMEX making, moving the price, but there was also a lot of external
Right. So to that point, China was buying two ways. They were buying during Shanghai hours and just not selling. That was the Chinese hunt brother, right? So they were buying it in March. He just started buying. He had been buying, but he started buying more, right? But between say, I'm not kidding, between say October of 22, after the Fed stopped hiking, and March of 24, when the hunt brother, the Chinese hunt brother, started buying, to give him a name. Between that time period, the open interest was going up and down, but China never stopped buying. They were buying over the counter. So that was the physical demand. The physical demand is still here. So I guess conversationally we've nailed this. But if we want to the information that you have here, you should go home if you like this, and you should now look at it. What did the market do? How much per move? So for example, these concepts that I'm talking about with 5,000, those 5,000 tap into what Iggy said. Every cycle. In this cycle, the average up was 5,000, took us up $10. In this cycle, the average up took us up $20. So basically it's cycles within cycles, and then a big picture. That's the way to break this down. So why do I say it that way? Because we are at the beginning of a cycle. We're at the very beginning of an open interest cycle. So how did this cycle go? Was it 5,000 per 10 contracts? Was it 5,000 per $100 or whatever the number is? 5,000 contracts got us up $10. 5,000 contracts got us up $20. 5,000 contracts got us up $50, right? So you use the ups, and then you say, what's the average of this? 5,000 contracts got us up $20. Well, this was 10, this was 20, this was 30. And now here we are at the beginning of a cycle. Is it a cycle or is it a cycle of cycles? That's how I look at this stuff. And once you start looking at it that way, now you break out your spreadsheet. Now you do the math. Slice the apple this way, slice the apple that way. When the market goes up, how much does it go up? When the market does a round turn, how much does the market go up? When the market goes down, 5,000 contracts. When the market goes down, how much did the market drop? How many contracts per $10? How many contracts per $10? How many contracts? Well, this one doesn't work because that's where the banks were. And that's the key to how to think when you're creating a regression analysis. And when you create a regression analysis, you create a system. And when you create a system, you make it faster and you create an algorithm, because you go from looking at this years out to months out to weeks out, and you say, where does the signal deteriorate? It deteriorates on the hourly. Fine, trade it on the daily and don't trade it on the hourly. So that's what I do. That's how I think about these things. So hopefully that's it. All the stuff that everyone has been saying here has been really good, because, well, it's been really good. I think you guys will get it. This is what we're doing here. I haven't even gotten to Bollinger Bands. So let me do Bollinger Bands quickly, and then I want to go.
So
Yeah.
can I just quickly just add something?
Yeah.
You know, we were talking a few weeks ago about how during Chinese hours it looks like the locals are buying at the open, but then
Yeah.
someone's slamming it.
Yeah.
Well, I heard recently on someone who I won't name that actually the Chinese central bank has changed, or the Chinese someone has changed their strategy, and they're no longer buying in Chinese hours. They're letting whoever it is, presumably Western banks, slam it in Chinese hours, and then they're coming in and buying it at the fix on the AM fix.
Okay. Let me comment on that behaviorally, and then we'll try and figure out if the reasons make sense. Behaviorally, forever, not forever, but behaviorally forever, if you bought it during China hours and sold it during US hours in the open, you made money. Or bought it during Shanghai's open and sold it during London's morning fix, you made money. And then you bought it back on the US close. I mean, if you look at those charts, the gold's been going up for the last 10 years when we sleep, and going down for the last 10 years when we're awake. Now, you take that behavior and you concentrate it, and it's been more obvious over the last 2 years that Shanghai opens, gold allocations go out, and the Shanghai banks, we call them Shanghai traders, Shanghai banks and Shanghai funds buy it on the open, but for various reasons, but they're just buyers, right? Okay. And for the last year, they buy it on the open, and it would generally keep going up or get slammed. But the point is, instead of it being bought on the Shanghai Open and then sold during US hours, it was bought on the Shanghai Open and went sideways. You have a little bit of a slam during the London fix, and then it will go sideways or higher. So that's how we got the market going up. Buy it in Shanghai, sell it for 15 minutes in London, and then buy it in US hours. Okay? Now, starting about 2 weeks ago, it became obvious that, Shanghai was being bought on the open, and then it was fading. If you look at the last couple weeks, the pattern of being bought and bought sideways higher later became bought, sold, and then bought during London. That's actually a really good observation, right? So it was Shanghai traders bought it out of the open. It's like me being a narrator. Shanghai traders bought it on the open. And now we're into the second half of the day, and the Shanghai traders are going to lunch, and they haven't come back, and no one's buying. And American bullion banks are fucking selling it. It's almost like they were pre-selling it for the London fix. Conspiracy, Shanghai buys it. China says, now I'm going to tie into what Scott's saying. A little bit of conspiracy, but behaviorally consistent. But that's what was happening. Up, down, up, sideways, up, right? Now it's up, down, up, right? So it would make sense that if you're China and you have more to buy, you're not going to buy it during Shanghai anymore. You're going to buy it when everyone's selling it, because you need liquidity. So when the Shanghai buyers buy it, you don't buy it. In fact, if I'm China, the government, I may even sell some. I may even give the impression that I'm selling. That's what Goldman Sachs did for years, for decades. We would see them selling on the floor. Oh, look, Goldman Sachs is selling silver. And then I'd call my buddy. He goes, oh, yeah, I'm buying it up here. I'm like, what the fuck are you selling that for? Because I want everyone to think I'm selling it. And so he'd buy it upstairs. Anyway, so if China were to do that, that would be brilliant. I don't think they're doing it. I think what they're doing is they're going, we're not going to buy it during those hours anymore. We're going to buy it when everyone's selling it. So if China is like us, they're buying the dips in London. So, Scott, I don't know if that's what's happening, but the patterns of trading have definitely gone to that. I agree with you on that. That's a good point. People are still coming in. Are you fucking kidding me? Come on, guys. Probably got kicked out and got thrown back in. All right, so let me just take. This is over 2 hours now, right? So forget that bet. All right, it's Father's Day. Let me stop that. I want to go to the Bollinger Bands and end this.
What's the theta on the time lapse?
Apparently, there is no theta. There's only negative theta. So the options, if you're short an iron fly, you're smoked, right? Okay. So I want to look at the Bollinger Bands.
I think we went from neg to renege somehow.
Exactly. All right. Here we go. All right. So just the Bollinger Bands, right? So ignore this for now. I want to just look at this, right? So here's silver, right? So I bought it, by the way, just to give you an idea of how it works. I bought it here when it made this high intraday. I should not have done that, but I did it. I'm supposed to wait for the close, but I bought calls. Had the market went up, I probably would have bought more. Seriously. And so my calls were my stop out. I didn't make any money, and I started losing. I'm fucked. I'm screwed. And then this happened. I'm like, okay, it's going to happen. It's going to happen. And it happened. Day 1, day 2, day 3, day 4, day 5, day 6. And now you've got this rollover and back off. And then I said, so we're staying with the Bollinger Bands. That's the Bollinger Band. Now, you'll notice on this, the Bollinger Band, this yellow thing here that we all discovered together is Bollinger's version of the bands are too tight. I'm sorry, the bands are tight enough. Beware, the bands are ready to break out. Okay? And so I use his visually because it's actually very helpful, and I have a new trade idea from it now. I have a refinement. Okay, so that's that. Now let's move to gold. I want to show you gold weekly. In the past, you guys have often heard me say, volatility breathes. I'll say to you, inhale, exhale, right? That type of shit. You hear me say that all the time. It's easier to spot the inhale and exhaling on weeklies or monthlies, or weeklies really. And dailies, it becomes easy too. But when it really gets going, you can see it on the hourly. Now look at this weekly here. Look at the spacing. Almost the same. It's not exactly the same spacing. Look at this. Inhale, exhale. And this is see this cycle here from February of 24 through, looks like, so you started in, say, December of 23 to April of 25. This is the whole world getting on the same idea. I want to buy dips. I want to buy it. This is inhale and exhale. All right, so I want to go to gold. I want to go to oil next. Now, that's weekly, right? So daily. All right. What day was it again, Scott?
I think it was the 8th of June.
Yeah, so here we go. Scott reached out to me, and I don't really return a lot of text lately. I just got lucky and saw his. I was on my phone at the time. I'm just, there's too much. I need a real intern. All right, so anyway, so on this day, I think the market was near its highs. It was like right here. It was positive. Scott says, hey, are you getting a signal on your Bollinger Band here too? And my response was, oh shit, yeah. It's pretty clean too. The market was here. And of course, the market closed here, but it never violated it. Now, you could say that it violated here, but no, it's where it closes that matters, right? So here we are. So here's your breakout. Market goes higher, crosses the band, bottom band goes lower. That's day 0. Day 1, day 2, day 3, day 4, day 5. All right. The signal is over. The market can keep going, but the risk reward is not there. Why is the signal over? According to my math, because when you bought it here, you're supposed to have bought it right here, technically, right? You're supposed to risk 1 to make 2, or risk 1 to make 3, or risk 1 to make 10. I don't care, but I've optimized it to be risk 1 to make 1.5 to 2. And so you say, I'll buy it here as long as it doesn't settle below this price, I'm long. And then you move it up to here. As long as it doesn't settle below this price on this day, I'm long. And you just keep ratcheting it up. This day is that line. This day is that line. So the Bollinger Band becomes a trailing stop. And you would have hit a fucking home run. And I didn't trade it because I was obsessing about silver. But there you go. Now, the other thing I want to notice is, I want to show you is the visual thing here. I'm not sure what this is called. BB squeeze, it's called here. You can probably find it in various setups. You'll notice is that the yellow bands tell you that it's really tight, really tight, really tight. They don't tell you when it's not really tight. So when it's not there after being really tight, that is corroborating with my signal, right? Here's the first day of it not being there. There's no yellow bar. You're supposed to buy it. Wait. Right, you're supposed to buy it here. On mine, you would have bought it here, right? Okay, this is a buy. By the way, my buy is here. My buy is on the 9th. Yeah, so my buy was on the 9th, which is still in the bands. Anyway, the reason I'm bringing this up is because that's how it works. And, does every market, does it work all the time? No. I used to trade this in 10 commodities a week, right? Everything. I would trade this in everything. And I would just do it on the hourly. I get an hourly signal, I buy it, I take home winners. I get an hourly signal, I sell it, I take home winners. And what I found is that in some markets it worked better than others. And obviously, but what I've learned over the years is that the markets that worked better were the markets that were trending. And oil is working now. Oil, look, here's a breakout in oil. That's a breakout in oil. See this? Technically, it's not a breakout because we don't have the yellow lines here. But let's say that I bought this. I would buy that. In the past, I would buy that. And it would break out and I get stopped out, right? So it doesn't work, right? But it does work. The point is, the behavior here is the behavior of a market that's completely changed its mindset. Number 1. Number 2, macro discretionary is back in the market. And number 3, I didn't buy it. So that's why it's a good trade. The thing I wanted to bring to everyone's attention, anyone who trades options, is I started back testing this. And here's what I found out. I didn't do it scientifically yet, but this whole little system I'm describing here, the way that I use it anyway, there's a classic way to use it. It was devised, I created it because I'm an options trader, and I was trying to figure out where it was good to buy my options. Where it was, I would always be long options, and I would be like, all right, I had a very hard time being short options. Genetically, I'm an options long player, and I wanted to become an options short player, so I developed this system. I would get short options at a certain point, and then when the market did this, I would get out of my options. This started as a when to cover my short options play, and it became a directional play. So I want to go back to that, to anyone who trades options on a butterfly basis. We're taught using this system and these yellow bars that when the Bollinger Band squeeze happens, when you get the yellow bars, that tells you that the market has inhaled enough to get ready for a big move. And I'm telling you, based on my career and based on the recent backtest I've done here, when you get your first yellow bar, you sell options. And when you get your last yellow bar, meaning the first bar out of it, you buy options. And this is what I found, because in my career, this always happened, meaning I would get the yellow bar in a different way, but I get the yellow bar and I would start buying my options back. And what I found is that I would lose money for a week, for 5 days before I made money, lose money, and eventually I would make a lot of money, but I had so many false breakouts, like these false breakouts that you get in here. That's a false breakout, right? That I wouldn't make money. And so when you combine that experience with this, with my back test, when you get your first yellow bar, buy a call butterfly, buy the wings, sell the meat. Sell an ironfly, sell the straddle, buy the wings. Why? Because over the next 7 to 10 days, when this happens, everyone pukes their options. Everyone pukes their options when this happens. And it's kind of fascinating. So it's kind of like, if this is the reason to get long the market or long options, then this is the reason to sell it. So buy a butterfly, sell the meat, sell the vol by doing a butterfly. And then when you come your first one out, take a leg off. And that's what I'm doing from now on this trade. That's it. All right. I'll take a quick look at the comments. Oh, some on the yeah, I know, Tony. You should have taken the over. I see. But we didn't bet on it, but next week you will. I'm gonna answer 2 questions, then I'm gonna go. The first question was Bollinger Bands, what do I use? 2.0 is standard when you log into Bollinger Bands. I use 1.5. And I use 1.5 not because it's better, because I like to be early. I would rather be early than late. That's how I operate. So I go 1.5. That's 1.5 out there. It'll get you in a little bit sooner. Okay? It'll give you, you'll have more false starts, but you'll never miss anything. I would rather have a false start like I did with my silver one than miss it. That's how I operate. Randy, I think, uses 1.9. Randy?
Yeah, and I kind of did that because if you throw the probability of being inside or outside, I think my 1.9 is 95%, and that's why I went with that.
So you optimized it.
Yeah.
That's good. So you optimize it. I'm managing my expectations. Like I should optimize it, right? But 1.5 is right. I mean, not 1.9. If it's right, it's right. That makes sense. That makes sense. I appreciate that. The other question is, what charting software do I use? I use, for charting, I use TD Pro. Now, I'll share something with you guys. I am, look, you don't see me marketing, but I'm an influencer for TD Pro. Okay. So that's their best product. They have no better product. And frankly, there really is no better product except for if you need real-time feeds for futures. You don't get real-time feeds for futures on this because the CME locked them down. You get real-time feed futures for Thinkorswim, which I use, or anything else that has a prime broker attached. So unless you need real-time feeds for your charting, I use TD Pro. I'm not. Hold on.